Okay, so picture this. The global economy, it's the swirl of politics, central bank moves, those big trade talks always looming. The real question is, how does all that stuff actually hit the markets? And maybe more importantly, how does it affect you? Today, we're going to do a deep dive into some recent market updates, some analysis. We're really focusing on, unexpected election results, key economic decisions, those tariff deadlines that keep popping up. How's it all shaping the financial world right now?
Yeah, and our mission here really is to cut through some of that noise. We'll definitely look at the immediate reactions, sure, but then dig into the underlying pressures and also the resilience, which is actually quite surprising in some markets globally. The idea is to highlight the connections, the bits that really matter for understanding, where things actually stand.
Right. And you might actually be surprised maybe how some markets seem to just shrug off major political news, while others are, really bracing for impact from tariff deadlines that seem pretty far off. Let's unpack this. Okay, kicking things off, let's talk Japan. Big political shift there recently. The ruling coalition lost its majority in the upper house. That means, tougher time passing laws. So from a market angle, how did that land initially? Was it the usual knee-jerk sell-off?
Well, what's really striking is how calm things were right after. I mean, despite that political uncertainty, the yen actually firmed up a bit, maybe 0.4 to 0.7%, which maybe surprisingly some saw as a kind of relief, perhaps because losing the majority force is a more pragmatic approach, less ideology maybe. Or maybe just the uncertainty was resolved. And crucially, Tokyo had a holiday, so that dampened the immediate trading reaction. Plus, there was huge anticipation building for those big U.S. tech earnings, think Alphabet, Tesla. And markets were already really focused on the U.S.-EU trade talks anyway.
Okay, so if I'm getting this right, even with Japan's own political situation looking a bit shaky, these global things like U.S. tech earnings, they were actually a stronger force. Does that suggest like a new pecking order for what moves markets, or was this just a one-off lucky timing?
It suggests, a really fascinating shift in where investors are putting their focus, that surprising calm in Japan, even with big political changes at home. It really shows a kind of reprioritization. In this interconnected world we're in, global growth stories, tech giants halfway across the world, they can sometimes have more immediate impact than domestic politics.
Yeah.
It kind of redefines risk for sophisticated investors. We actually saw hedge funds positioning for this before the election.
Oh, interesting. So they were already seeing this trend. What else were they picking up on that maybe the initial market reaction missed?
Yeah, a key thing here is that before the election, hedge funds were actually cutting their Japanese stock positions pretty fast, too fastest pace in over 2 months. They were citing worries about, the coalition weakening and those growing fiscal problems Japan has. So while the market looked calm right after, there was definitely preemptive action by some big players looking past the immediate headlines, which it raises a good question. Is that calm resilience a sign of real stability? Or is it just delaying the reaction to deeper issues like fiscal health and those tariff worries that haven't gone away?
That's a really important distinction. Okay, shifting gears towards Europe now. The European Central Bank, the ECB, they're expected to keep their main rate at 2% this Thursday. This comes after, 8 cuts in a row? That was quite a run. So why the pause now after being so aggressive with easing?
Well, this ECB pause, it's not just about being cautious. It really highlights how central banks are navigating this new geopolitical tightrope. You got a weaker euro making imports more expensive, right? And then the direct threat of U.S. tariffs hanging over them. So easing further could actually, ironically, backfire. It might fuel inflation or, worse, pour fuel on trade disputes.
Right.
It really signals a shift, I think, moving away from just focusing on domestic inflation targets towards this more complex dance with global trade. They have to wait for clearer signals, basically, before easing more.
That lays out the dilemma very clearly.
Yeah.
And speaking of those trade tensions, that August 1st deadline for U.S.-EU tariffs, it's coming up fast. How's that showing up in the broader market right now?
Yeah, this is where you really see those connections playing out in real time. Wall Street futures, for instance, they've held pretty firm, partly because there's optimism around defense stocks, and again, those upcoming U.S. tech earnings everyone's watching. But investors are definitely keeping a close eye out for any clues on U.S.-EU trade. And just the threat of these tariffs, it's already fueled demand for safe havens. Assets like gold where people park money when things feel uncertain. We've seen spot gold tick up about 0.5%, nearing $3,365 an ounce. It's a classic market response to the unknown, really.
And it's not just US and EU, is it? The bigger trade picture obviously involves China. Any word on a potential Trump-Xi meeting on that front?
Well, the U.S.-EU talks are definitely ongoing. They're hoping for a deal before August 1st. That's the immediate focus. But any serious talk about a Trump-Xi meeting, that seems unlikely until October, maybe later. It kind of indicates that while the immediate trade issues are being tackled region by region, those deeper, more structural tensions, especially between the U.S. and China, they're playing out on a much longer timeline. Suggest no quick fix for some of those big systemic issues, maybe pushing major decisions past the next election cycle even.
Right. Okay, so we've talked about these big macro shifts, trade, central banks, but how does this actually translate down to the ground level? How does it hit specific industries, their global operations? Let's maybe zoom in on one example. The global petrochemical industry sounds like it's going through a pretty major shakeup. What's happening there?
Yeah, this petrochemical situation, it's more than just an industry downturn. It's really a profound reshaping of global industrial power, you could say. You have this overcapacity in China, right, that reflects their own market maturing, so they're pushing exports hard.
Yeah.
Meanwhile, in Europe, costs are rising, energy, regulations, and that's really hurting their competitiveness.
Hmm.
So companies, big names like Lyondell, Basel, Dow, ExxonMobil, Shell, BP, Total Energies, they're all either shutting down plants or selling them off to try and get more efficient. But it's not just about efficiency. It's kind of a leading indicator showing how global manufacturing supply chains are being redrawn, maybe permanently, could lead to new regional hubs, big shifts in jobs.
That's a really powerful way to put it, a leading indicator. Okay, back to the U.S. side for a moment. How's the Federal Reserve fitting into all this, especially with some interesting political comments flying around?
Well, U.S. Treasury futures have been pretty steady, actually. The market has priced in no rate cut for July, but there's, a better than 60% chance priced in for easing later, September, October, perhaps. What's also significant, though, is, yeah, the rhetoric from Trump targeting Fed Chair Powell. It definitely adds this kind of underlying tension to the market. It just shows how political commentary can seep into market sentiment, even when the Fed itself is holding steady on policy for now. It's that constant push and pull between policy and perception.
Yeah, always that tension.
Yeah.
Okay, and finally, before we wrap this all up, let's not forget oil. It's always sort of the foundation, isn't it, amidst all this uncertainty? How's that market looking?
Oil's been pretty steady, too. Brent and U.S. crude are up slightly. It's largely being held up by OPEC, plus keeping supplies tight. That signals the cartel is still committed to, keeping prices stable. But offsetting that are these ongoing talks about new EU sanctions targeting Russian energy exports that could definitely disrupt supply down the line.
Right.
So you've got this fascinating tug of war. Disciplined supply management on one side, potential geopolitical disruptions on the other, keeps prices in a pretty tight range, at least for now.
Okay. So bringing it all together then, what does this all mean for us? For you listening, we've definitely seen a fascinating picture. Global markets showing surprising strength in some places, even while they're dealing with big political shifts, central banks being cautious, and those very real trade pressures.
Yeah, what's really fascinating is how it all interacts, isn't it? The global interconnectedness versus the local pressures, from Japanese politics influencing hedge fund bets to U.S.-EU trade talks steering ECB policy, and then Chinese overcapacity hitting European chemical giants. It's all linked. We're seeing how, say, excitement about U.S. tech earnings can offset political worries, or how the threat of tariffs pushes up safe havens like gold. It's complex, definitely dynamic.
So hopefully you now have a clearer sense of how these complex forces are really shaping the world's finances, maybe a bit more insight than just catching a headline.
And it does raise an interesting final question, I think. As we head toward that August 1st tariff deadline and look further out to maybe a Trump-Xi meeting in October, what kind of unexpected ripple effects might these big trade developments have, especially in markets that seem surprisingly stable right now? Which specific sectors or maybe commodities might suddenly feel the squeeze, something for you to mull over?